All right. Welcome to the Happy Hour Money Podcast. My name is Josh Bennett, alongside my partner in crime, Isaiah Douglas. Isaiah.
Good to be here, Josh. And we have a special guest today, someone that, we've both learned tons from over the years. And that is Meb Faber. He's the co-founder, chief investment officer of Cambria Investment Management. He's a podcast host as well. Both fans used to religiously listen to Meb. I've backed off a little bit, but time constraints are one of those things. He writes a bunch, has a handful of books, also a great Twitter follow. Meb, thanks for being here.
Awesome. Thanks, y'all.
I want to ask, I guess, initially to kind of set the stage. So what you do at Cambria and just the thought process of how you think about investing, I think it's going to come out throughout this, but you do have a podcast. You've been able to interview a lot of really, famous, really successful investors over the course of time. And being a podcast host, one of the big things is you have to be able to ask really good questions. I want to start with kind of what's a favorite question that you like to ask guests to kind of explore it and get into the way that they think.
Yeah. So there was a lot in there. First is, my day job as CEO. I started of Cambria, which is an asset manager, very traditional in some ways, investment company. We've been around for over 15 years now, but mostly an ETF shop at this point. We got a dozen funds, about $1.6 billion in assets, and over 125,000 investors, which is a little crazy to say. We're based here in Los Angeles and we have a new office. So listeners, if you're around Manhattan Beach, come say hi. We'll buy you a coffee or a beer, go for a surf, walk by the ocean, something, look at the sunset and talk quant investing. Podcasting, part of the origin story of my company, goes back pre-financial crisis. So pre-2008, we got started in 2006, started managing money in 2007. And we really became known for our research and content. Now, this started out as academic papers, even some op-eds in the newspaper, then books and blog. And then, of course, more recently, what you mentioned is a little more social, whether it be the podcast, which is, I think, nearing 500 episodes, Twitter, and who knows, probably at some point, TikTok and holograms and whatever is coming next. But, part of that, looking back on it, is we very much consider ourselves a research-driven company. We've never even had any salespeople until the last couple of years. So really it was all about content and ideas. Now, to be totally honest, part of that was simply necessity. When you start a company from scratch and you're not coming out of some amazing pedigree of whether it's Goldman or Bridgewater or something, and you're literally bootstrapping it from zero, you don't have a lot of discretionary cash to be spending on things like marketing or advertising or sales or employees or really anything. And so, the first decade was all about hustle. And so the easiest way to hustle for us has always been content, because if you write something that people find interesting or compelling or really stupid, and we've been on both sides of it, or embarrassing, it gets whipped around the internet. And, next thing you know, you can have a reach of hundreds of thousands or millions of people pretty quickly. And so this has been a non-traditional, kind of consensus route for most asset managers. However, if you go back in history, there's been plenty that have done it just with different mediums. We talk about Fisher Investments, which is now a $200 billion investment advisor. He started out with magazine articles and direct mail. Rick Edelman, which is now part of Financial Engine's combination. I think they're in the hundreds of billions. He was a big radio show, book guy, on and on. I mean, there's Dave Ramsey. He's not an investment advisor, but he does hundreds of millions in revenue, but very traditional radio, books, sort of thing. So anyway, the long-winded answer to your question was, which I've yet to answer any part of it. But the question we like to ask, we had two different ones. We were kind of in the second wave of podcasts. There was like the Joe Rogan, and then in my industry, there were some early adopters like Barry Ritholtz at Bloomberg. We were kind of the second wave, and then right before the big J curve up. But so a lot of it in the early days was experimental. We had different types of shows. We did what we call radio shows. The main vibe is like what we're doing here, like happy hour, chatting, sitting on someone's shoulder and listening in to a conversation. But we did some other ones too, where we would read almost like audiobooks or research pieces. And we do a segment called the best investment writing. So we were experimenting. But there was two questions that we had asked consistently in the first probably third of the podcast when we had guests. We asked them somewhat of a weird question, but we said, what is something out there that is beautiful useful or magical that you've discovered in your life that is that most people are unaware of? And something about that question generated the absolute weirdest answers, but it triggered them very quickly. People were like, oh my gosh, I know what it is. It's this axe. Is this beautiful, like woodsman axe that's used for chopping down trees. I'm like, why? What a strange thing. And we would try to volunteer some. Sometimes it's websites, sometimes it's little items. From people, it's conceptual ideas. We summarized all of them at one point in a post that you guys could probably find that had all the listing. That it's pretty cool. And we chipped in our ideas over the years. And the second kind of epic of the podcast was a question where we said at the end to the investors, and we tweak it a little bit if you're not a pure investor, but we said, what's been your most memorable investment? And that question triggers a very visceral reaction for many people because, and most of the time, honestly, with the pros or the older crowd, it's not necessarily like their best investment. It may be the one where they lost all their money, or, they did something really foolish, or they did something really smart, but it didn't work out, or all sorts of compilations of things there. But it's fun to listen to people. We should probably ask that at the beginning rather than the end, because it gets people a little off-footed. Anyway, as you can see, I like to talk. So the main part about my podcast is we have an editor. So we edit down Meb's section and usually about in half because I get a little diarrhea of the mouth. So that was the short answer. Yeah.
Yeah, the short answer. And you just listen to it at like 1.2, 1.5. And then if you have a fast talking guest, you got to switch back and forth. Be like Meb's portion, you speed up. Right.
I'm going to tell you a quick secret, and we haven't implemented this yet, but I was talking to my producer and I say, I listen to podcasts at 2x speed on default, and my wife will get in the car and sometimes it'll like auto sync with my car and autoplay. And it sounds like, a bunch of chipmunks. It just sounds, she's like, are you totally insane? She's like, did I marry a psychopath? Like, are you really listening to this? And I say, well, but like once you listen to 2x, you go back to normal. It's unconsumable. It's absolutely, you can't listen to it. But the thing about speeding it up a little bit, 1.25, 1.5, it makes the guests sound a lot smarter. They're very quick, right? And they're on top of it. So I was telling my producer, I said, is it possible we could just actually take the show and speed it up to like 1.2 and not tell people? So, right, it's like the default is like 1.2. So we haven't done that. But I think if all of a sudden you're like, wow, Meb sounds like he's pretty smart. He's been taking some Joe Rogan pills or something. I don't know. But yeah, I'm a slow talker, so usually can consume a lot more by speeding me up.
Yeah. I wanted to ask basically a question about what's an investing belief that you've changed your mind on over your career that maybe you held like, hey, this is true. And then over conversation, research, and just like kind of being curious that you've been like, oh, this totally is a reframe and I believe something differently now.
Yeah, there's a lot. I think the big one, the longer I'm on the other side of the desk, meaning not just the investor, but the professional who's managing other people's money, is simply how mismatched most investors' stated time horizons are versus how they actually behave. And let me be very clear, this is not simply targeted at individuals and like, oh, I'm going to dunk on the Reddit crowd and the Robinhooders. Institutions are just as bad at this, by the way. It sounds a lot more sophisticated the way they make the decisions, but it is a total mismatch. And you've probably heard this story or this example, but I'll give it to you again for the listeners, is that, my belief a long time ago was that you could get a pretty good idea of a strategy or a manager or an asset class or whatever it may be in a reasonable time frame, meaning a couple years. And now that I've spent a lot of time studying history and studying investors, the relatable example I give is, if we're grabbing a beer, coffee, we used to do all these meetups. We do happy hour meetups in LA and say, anybody come, hang out, we'll talk, or go to conferences and chat with people. And, we have 12 funds. There's always something doing terrible, something doing great, something doing terrible, almost by definition. Hopefully most of them do better over time on average, but usually something stinking up the joint. Right now, that would be foreign deep value stocks. They've particularly Eastern Europe and a lot of emerging has really struggled this year in the last decade, really. But so someone will come up to me and they say, Meb, love your whatever blog, your podcast, your fund. I bought this fund, and it's not doing that great. I like the book, but the fund is not doing that great. But I like you. you seem like a nice guy, so I'm going to give it 6 months. And I make two comments. And the first is, oh, it can get way worse than that. I was like, you think that underperformance is bad? It can get significantly worse. And that usually kind of disarms people. They're like, what do you mean? Like they're expecting the portfolio manager to get defensive, say, oh, well, Fed is raising rates and there's inflation, or there's war in Europe or something on. But the reality is that if you study enough history, you understand that normal market returns are really extreme. And we can certainly get into that. But I'll say it can get worse. And they say, okay, well, how much longer should I give it if I'm not willing to give it 6 months? And I would say 10 years. And they would smile awkwardly and laugh. Like, oh, Meb's joking. And I'd say, no, I'm serious. If you're going to allocate to an asset class or an active manager, same decision, your expectation should be a decade minimum. And there's a quote by Ken French. We had Professor Fama on the show yesterday, and the old Fama French combo. But he had a quote where he's like, investors that draw any inferences from 1, 3, 5, or 10 years of returns are crazy. There's no useful information you can usually draw from such a short time frame. And so I think that what I've changed my mind on is how long it takes for these things to play out. This is a good example recently where for the majority of the decade post financial crisis, there's been one game in town, and that's US stocks, and particularly market cap weighted or growth stocks. That's not normal, though. That is not the base case. The base case is, US versus foreign is a coin flip over time, value versus growth. Usually value wins, on and on. There's all these things. In the last year or two, that regime has changed, right? So what we saw in the 2010s is now different in the 2020s. So the end of that cocktail joke is when people used to say, you need to give it 10 years. I now say 20. Now, no one talks to me at happy hour anymore about investments because they know what they're going to get. But the reality is most investors, and we've done poll after poll, academic study after academic study, they base their decisions based on the past 1 to 3 years. I actually tweeted yesterday an old study from John Bogle, and he looked at the top performing investment managers in the 70s, the 80s, the 90s, maybe even the 2000s. We did one that followed up in the 2000s, and the massive outperformance they had. He said, how did they do the next decade? Well, they underperformed. So if you just chase the hot manager, you consistently got in trouble. And then we did one where we looked at all the mutual fund managers of the decade and then looked at their returns the next decade, and they all underperformed. So, investors, we love to, like moths, gravitate towards the bright light and what's doing well. But often, as you build into your process, it's useful to not only kind of shy away from what's crushing it or really doing well, but also lean into potentially, and there's a lot of ways to do this, rebalancing, thinking about it, but tilting towards the things that have really been stinking it up. Commodities this year, a great example where they had been kind of garbage for a long time. And here we are with natural resources being one of the very few things up in 2022, and then helping in a world of, crazy to say, pretty high inflation and rising interest rates.
Yeah. One couple different comments. Josh, I'll let you ask the next question, I promise.
You're good.
The fact of like telling someone, oh, it can get way worse, reminds me of a conversation I had, and he's been a guest on your show, Marty Bergen with Dunn Capital, and they run a managed futures fund that's absolutely crushed it this year. Unbelievable, right? But he talks about that too. Like when you want to go to allocate to their fund, he's going to tell you how bad it can get, not why we're the greatest. And it's so different than when you think about traditional asset management, trying to be like, oh, look at our fund, we're so great, this is why you should invest it, versus saying, no, you need to understand how bad it can get and say that you're committed. And I'm going to try to talk you out of this decision before you give me money. And that, to me, the first time I went through that with a client, I was like, that is wild. But I love the approach because you get money that hopefully understands why it's invested there and it's sticky, and then you get rewarded over time. So
what's so important about what you just said is, and this applies to life, this applies to relationships, this applies to jobs, this applies to almost anything, is people come up with an expectation and then they anchor to that expectation. So say in your head, you're like, you know what, I've had an amazing year. I'm going to get a giant bonus this Christmas. And then you don't. It's a huge emotional fracture, right? You get so let down and sad, or, you plan out a life with a significant other and it doesn't work out, on and on and on, right? But the same thing happens with investing. And so the reason it is so critical to study history is that you can at least start to understand the base case. And what I mean by the base case is what can happen in markets and how bad has it been. US stock market's gone down over 80% before. And if you were to tell, and the US, going back to the very early part of our conversation, the US stock market has gone nowhere for decades and has underperformed bonds for many decades. I mean, we're talking 40 to 60 years where there is no equity premium, right? Like stocks for the long run. We all want to believe in that, but the reality is it's not happened in the past. And so if you have just an expectation that's untethered to any reality, so a lot of investors coming into this year, the surveys were showing their expectation for their investing portfolio was returns in the mid to high teens, 15, 17%, right? And you say, well, what's the average return of stock spin? I'm going to round up. And even if you get to 10%, it's not, but let's just be an optimist, 10%. But people are expecting 15 to 17. And so what happens, all of a sudden, you have a year now, one of the worst years ever, if not the worst year ever for traditional stock bond portfolio after inflation. People start losing their minds. And when they start losing their minds and emotionally freaking out, that's when a lot of the bad behavior happens. But if you're an investor, it's like, I've studied history. I understand that 60-40 portfolio can get cut in half. I understand stocks can go down 80. I understand entire stock markets have disappeared before. It's happened in Russia and China altogether. So the Russia example this year shouldn't be a huge surprise. On and on and on. You at least have a foundation with the huge caveat and asterisk that it's always going to be weirder in the future and more extreme. By definition, it has to be, right? It can't be less weird. And so I think, we often talk about my favorite investing book is Triumph of the Optimist, which is a great historical record of what's happened in the investing space for the past 120 years. So I think that's the important lesson is you really got to at least, and that's hard. If you're an investor that is new, or you don't have an advisor, it's hard. And you learn by one of two ways, going through it and the very real pain of losing money, or B, having an advisor who's going to hold your hand. And both are okay. What's not okay is what everyone does, which is don't have a plan and just wing it, because always that work. I mean, anyone who's ever been on a diet knows that is a recipe for disaster and non-compliance.
Yeah, for sure. I mean, we see that almost every single day where basically a lot of times we become therapists more so. And I mean, we actually kind of use the quant-based investing to really kind of have a focus on how do we hedge downside as much as possible, just with the idea of to have a plan that's, a financial plan that's easy to implement. Well, you have to make it as stomachable and reliable as possible, just because if you need to buy a house in 7 years and that's the year the market goes down 80%, well, so much for your plan, right? Yeah. So along that lines, I mean, we're obviously in a time frame of some slight turmoil in the world. I mean, there's a lot of doom and gloom predictions out there. So when we're in this sort of situation, I know you have a knack for finding sort of unexploited opportunities. One, like how can investors take this sort of situation? One, use a quant-based methodology for making their plan very achievable and kind of bringing it back to the the logical as opposed to emotional. But also then, how does an investor then look for opportunities in this kind of environment? Has it changed with all the money printing and everything that's gone on over the past 4 years and the inflation? Has quant changed? What are kind of give us the lay of the land there in terms of how to relate to just your average Joe investor?
Yeah, I mean, the change is a constant, right? And so the question is always, is this something we've kind of seen before, or does it rhyme, or are we in totally uncharted territory? I often joke or do a Twitter poll where I say, okay, we find out tomorrow aliens are real. There's an alien ship at the bottom of the ocean. I don't know, whatever it may be. Stocks up or down, So there will be things in the future we've never experienced, and you don't know how to deal with it. And often, I think people's best guess is consistently wrong. I think one of my favorite charts is you go back for past 120 years and you have the S&P chart, and it has the top 100 crisis events the last 100 years, right?
Yeah, I love that chart.
But despite all these terrible, horrific, awful things that have happened, that chart just keeps just going up. And the further you zoom out, the better it looks, right? If you zoom in, it looks really scary. You zoom out, you're like, oh, this is beautiful. So I think it's important to start out with sort of what is your base case, and build a portfolio that is resilient, hopefully, to any kind of future outcome. And there's a few different ways that people traditionally do that. And there's plenty of ways that I think are under the Venn diagram of fine okay, good. If you ask me like optimal, we could spend the next 5 hours, academic discussions going super deep, but usually that's the final 10%, the big, huge muscle movements. I think that really anyone can accomplish simply, but are the things important at the end? Sure. We did a paper called the investing pyramid. That's like the old food pyramid. Like what's the base? What's most important? And, it's like, hey, have a plan in the first place. You want to start investing early as you can. You want to pay low amounts in fees and taxes. You want to save and invest as much as you can, on and on, right? Like the things that really matter. You want to not nuke your portfolio by going behaviorally crazy and trading meme stocks, right? And so automating your 401k, all these things. But if you look at just like the actual just investing portfolio, our default, we love talking about the global market portfolio. If you just went out and bought the entire world, that's roughly half stocks, half bonds, half US, half ex-US. That's a pretty good starting point. Now, we talk a lot about real assets, so real estate, commodities, natural resources, tips, all in that category. And so this is like the old Talmud portfolio, 2,000 years old. They weren't investing in listed securities, but it was a third land, a third business, a third reserve, so cash and bonds. And those two portfolios are near impossible for many people to beat already. And the most amazing thing is you can invest in those portfolios. The best time ever to be an investor for essentially free, pretty darn close to zero. That's the base case, right? Like that to me is the start. The weakness of the global market portfolio to me is it doesn't have enough in real assets. And this year is a perfect example. It doesn't really expose you enough to potential inflation. And inflation has not mattered for a US investor in 40 years, right? Investors around the world, it has in plenty of countries, but many it hasn't. And all of a sudden we're waking up to this environment that the vast majority of professional investors have not experienced. And so, not surprising, this year is something like 95% of mutual fund and ETFs are down on the year currently. So that's where we start to deviate. We have a buy and hold asset allocation ETF that's just meant to, hey, you want long exposure to all the assets in the world? Here you go. We're going to do tilts towards value, tilts towards momentum, yada, yada. And then, we have two pretty big departures from a traditional market cap weight, the two being value and then momentum and trend, but trend following being the big pillar. And those take you to a different place. And I think it's a warm and fuzzy and happy place, but others don't think so. And I think, look, could you be totally fine? And would you be totally fine with a buy and hold stocks, bonds, real assets? Yes. Does it have significant challenges? Absolutely. And the biggest one, which is what you see this year, is when the times get rough, you don't do anything. Right? You just are completely exposed and correlated to what's going on in the world. So the broad economy, you're tied to, it's sort of like the same bet. You're levered to what's going on in the world. So when everything hits the fan, financial crisis, COVID, potentially this year, 2023, everything goes down together. And I ideally, you would actually want your portfolio to do the opposite, but I think it's fine. If you have a long-term perspective, 5, 10, 20, 40, 50 years, totally fine. But it's just that sort of drawdowns that can be painful in the interim, which is for many people, we say it gets, the kink happens at -20, which is where we're now. And emotionally, we say it's a Richter scale. So every 10% after 20 is not 10% worse, it's 10x worse. So your portfolio is down 20, most can handle that. Down 30, like your advisors are getting some calls, right? Like people are unhappy. Down 40, I'm looking for a new advisor. That guy's an idiot. Why is he putting me in these things? Down 50, on and on. Right. So, but again, has happened before and is totally normal. It's not fun. There's a great quote by, can't remember if it's Charlie or Warren, but they say, if you can't they're like, we've been through over 50% declines in Berkshire over the years. And if you can't handle 50% declines and quoted securities, you shouldn't be investing.
Yeah. And I mean, the idea of trend following is absolutely something that we definitely hold near and dear. And you brought it up. Why do you think trend following works? And you want to kind of give a little bit of a conversation there, and then I'll have a follow-up after that. I'm going to try not to ask you 4 questions in one this time, Meb.
Well, we're assuming it does work, which of course I believe. Trend following is an old investing methodology. It certainly has its roots over 100 years to the time of Charles Dow and before, and plenty of other trend followers before that. And it's a simple methodology, but much like buy and hold, it's not easy and it has its own struggles. So traditionally trend following, you look great often during the stressful periods. So this year, 2008, COVID, perhaps 2000, internet bust, on and on. But trend following at its core, and I'm assuming the listeners are familiar, but we're happy to do a background. But at its core, is really keeping you in the game. So if you're thinking about, like, you go to Vegas, you sit down at the blackjack table and you got a bankroll. You're like, look, I just want to have fun and get free drinks all weekend. Okay. That's my goal. And so I'm going to make small bets and I'm going to have budget X amount for Friday, X amount for Saturday, and X amount for Sunday. And if I hit my stop loss, I'm out and I'll save the rest for Saturday so that I can still play. Well, the problem with buy and hold is you can certainly, on any single security, industry, sector, countries, they can go to zero. And for many, they can go to the equivalent of zero, which is down 80 or 90%. It feels about the same. If you're at Vegas and you lose all your money Friday night, guess what? You're no pina coladas for you Saturday, no beers by the pool, no nothing. You're going to be signing up for a timeshare presentation or something. I don't know, to get your drinks. But the whole goal of investing is you cannot get taken out of the game. You can't lose your bankroll, because if you lose your bankroll, you can't bet, you can't play, you can't invest. And so trend following is trying to remove that big left tail. And that left tail happens a lot. A lot more than I think people expect. These sort of 5-10% declines, usually not a big deal, but really after 20, so, the 40, the 60, the 80s, these haymakers are so hard to recover from. And, you lose 75%. And the problem, the compounding works both ways. You lose 50%. It's not 50% to get back to even, it's 100%. You lose 75, it's not 75, it's 300% to get back to even. So you dig these holes and it gets a lot more painful the deeper you get. So avoiding these giant holes is huge. Now, you can get into the psychology and physiology of why. There's the math reasons why it works, and then there's like the real world psychology. And, to be very clear, people use a different part of their brain when they're making money or losing money. And you can see this, listeners. Let's rewind the last 3 years. I guarantee you everyone has a friend who was, being the key word, making a ton of money on Dogecoin at some point, or on AMC, or on Tesla, whatever it was. Right. And they were telling you about it, by the way. They weren't keeping it to themselves. And they, were fantasizing about the Ferrari they're going to buy, or the condo in Miami, or the trips they're going on, bottles at the club, whatever. You're opening your statements, you're checking your phone all day, you're happy. And it's just those endorphins, like, it is just stimulating that same part of the brain that a lot of drugs do. Let's flip it. Let's think back, and hopefully it's not you, listeners, but if it is, embrace the losses and learn to accept them as part of it and learn from it. But let's say you were buying a ton of stocks that are now down 90% or 100%, or trading some of these cryptos, or have done the same, or bought a bunch of houses on leverage back in 2007. On and on. There's a million examples. We've all been through them. It's a different part of the brain. You're not checking CNBC and your stocks app all day. You go to happy hour, you don't want to talk about Shiba coin, to your friends. You don't want to bring it up at Thanksgiving dinner a month, where you're telling everyone, hey, everyone buy the Shiba coin I told you to, or whatever it may be, on and on. And so you're embarrassed, there's shame, there's a lot of emotions tied up, but it's a flight response. And this actually plays out in the symphony of the markets. So markets, when they're below their long-term trends, and we did a really old study on this that no one read, but demonstrated that the vast majority of the worst days occur after the market is already declining, so in a downtrend. But guess what? A lot of the best days do too. And it's simply because the volatility has expanded. And why has the volatility expanded? Is because people are uncertain. Today's a great example. Woke up at 5:30 to see what the inflation was. It's over 8%. People, that's a number we haven't seen in many decades. And people are uncertain. Is it going to get worse? Has it already priced in? Are we going to do hyperinflation? The Fed, on and on. Our interest rates, and this has real world implications. Like, used to be able to get a mortgage for 3%, and now it's 7 or something. So that uncertainty causes volatility. And the volatility, often we call them volatility gremlins, can eat away at your returns. So if you can kind of sit out these periods, and trend follower, there's two types of trend followers. There's the trend followers that say, you know what, I'm sitting this out, I'm just going to hang out in cash or something like cash. And then there's also the trend follower that says, you know what, we're moving to a downtrend, we're shorting. And so we're potentially going to profit or benefit from this downturn. There's benefits and drawbacks to both. If you're long short, you have twice as many chances to be wrong, but you have twice as many chances to be right. And one of the big benefits of a trend long short this year, for example, is if you put all the trend followers in a room, 90% are going to have the exact same positions to a degree over time. The big winners, they all should have been short bonds for a long time. And that has been a absolutely wonderful hedge to a traditional portfolio, on and on, or you just sat out or you invested in energy, yada, yada. So I hope that touched on a lot of the things, you guys. I'm sorry, I get going, but I think there's mathematical reasons why it works. I think it's one of the main strategies. It's the number one strategy I would add to a traditional portfolio, and almost no one does. And it's always a curiosity to me, because if you were to blind it's like the wine test, right? You got $2 Chuck, you got Chateau Neuf de Pop, on and on, but you took out the names and did the blind tasting. You said, just these are the return, these are the risks, these are the drawdown numbers for the past 50 years. Which do you choose? People are going to pick trend following for half their portfolio every time, and they never do. There's a lot of career risk. There's a lot of the me too sort of decision making. It feels a little crazy, but I think to me, and this year it's on pace for, I think, a record year this year. It's one of the best years ever with 3 months to go. So I don't want to jinx it.
Yeah. So your piece, you talked about a lot of research, and this follows along. So it's the quantitative approach to tactical asset allocation, and you've updated it in 13. So I have to see if I can get you on record to say when you're going to update it again, or if it's in process, because this is a great
I actually did a 10-year retrospective in what it would have been 2017, 2018 for the Journal of Wealth Management. But all these journals, the reason I did a couple academic papers and done was because, one, they take like a year to get published, and B, two is they're often behind like a firewall or a paid, these journals are total racket. So I said, I'm just going to start throwing them up all online for free. This also happened with all my books, but this is a different tiff I had with Amazon. So totally separate, but most of my books are now free. So I'm happy to update. I'll update it at the end of this year. It's not actually that difficult, but it gives a good, I think, warts and all overview of trend, because again, I think a lot of people come into this with the assumption that something is always going to work. And trend, the hardest part for trend is not the bad times. Trend almost always does well during bad times. It's when the S&P is going up 20% a year. And again, your neighbors at Thanksgiving dinner talking about how brilliant they are, and trend is probably lagging for whatever reason. So we always say if you're going to be a good investor, you have to be a good loser, because most assets and strategies spend the majority of their time in some form of drawdown. And so trend is not immune to that. And in trend, if you're actually implementing it on your own, so not just allocating to a manager, but you actually try to do it on your own, it's really hard for a lot of people because the batting average is low. It's, I don't know, George Brett level, Albert Pujols. But most people want like 80% of their trades to be profitable. And trend, it's like angel investing, it's like the power law outcomes. The huge winners is what really defines the portfolio. All these small losers is what really doesn't matter. But most people, the problem they have is they let the small losers become big losers.
Yeah. You touched on a point, I think, I don't know if you've, I heard basically Maria, I'm probably butcher her last name, Konnikova. She used to write for the New Yorker, but she wrote like The Confidence Game and The Biggest Bluff, which are like great books. I don't know if you've read these, but like I was actually listening to her on a podcast because so she wrote The Biggest Bluff, which was basically about her time learning how to play poker against like the best poker players in the world. And one of the things she was saying was like, kind of tying it back to investments was you don't realize like, how much 2% statistical chance of something happening happens until you're playing poker. And then you realize it happens all the freaking time, and I think trend following, like, I think in real life, and I think we're seeing some of those 2% instances right now. Like just look at what's happening in the world of bonds. Like I think, probably even less than 2% chance of this happening, right? But I think things like trend falling really help prevent you from hitting those statistics that actually, really do happen much more frequently than we think. It's kind of fascinating seeing the numbers.
Yeah, I mean, I think, I do a lot of angel investing too. And it's weird because there's not a whole lot of overlap between those two worlds. They both have a very, and this isn't a unique insight, but I think it's a critical one, is that, the investing world is defined by these giant outliers on the positive side. And, if you buy S&P 500 index, good news is you're guaranteed to own the Amazons, the Googles, Teslas, whatever it may be. And the vast majority of your gains come from like 5-10% of stocks. And this applies to everything though. Angel investing, I feel like there's a much better appreciation in venture capital for this situation because, they'll invest in a portfolio of 20, 50, 100 names, and it's one or two of them that deliver all of the return. So you invest in Uber, that's great. And the other 50 are zeros, or they return your money, or they're a couple of baggers, but it's really the 100 baggers or those type of investments that really drive it. It gets masked a little bit within an index. People don't see it as clearly as they would if they were individual positions, but that's the reality of it. And so if you think about that in terms of percentage that are losers, you start to become a lot more zen about the losing investments. Like it bothers me so little these days. It's almost like, okay, I want it to go ahead and go to zero, get it out of the way, be a loser, be done with it, move on, so I can get back to something else.
Definitely fascinating to look at it. But yeah, I mean, I forget the statistic, but you might even know it better than me. But even like right now, speaking like losers, like 20% of the S&P 500 or something, zombie companies, which basically means they can't afford their debt, especially in a rising rate interest environment. So if you think of that compared to on the other end of these 500 companies, there's the Metas and Googles and stuff of the world, all lumped in the same investment. So
yeah. Meb, as we wrap up, what are you most excited about? Personal, professional, can be all over the place. And you might have mentioned it before we clicked record because you have some big news, I know, on the Cambria front.
I'm not excited about the Broncos, that's for sure. But even then, I'm still going to the Chargers game this Monday.
Sorry,
I'll support them. It goes in waves with me. Like writing and research. There's times when there's a lot happening and inspiration for ideas, and there's times when not much. On occasion, my academic papers, I feel like they've been condensed into tweets at this point. We did one the other day. We have a couple that are sort of in process that I always say summer sabbatical for writing is going to happen, and it never does. But there's like 3 or 4 topics that I think are interesting. I think right now is one of the best times ever for exposure to value investments. And we've been saying this for the last couple of years. And I think the regime shifted in 2020. And value has really had a strong run. But if you look at the traditional spreads of value within the US, but also foreign, it's some of the highest levels they've ever been. And so some of these value investments, I think, will do totally fine. And if you look back to periods of inflation, 1970s, 1940s, value stocks were one of the best places to hang out or hide, depending on your perspective, but they did a much better job than the broad market. And of course, we run some value funds, so that could be me talking my book, but I'm very optimistic of the potential performance of value for the rest of this decade. It's not just the next year or two, but for an entire decade. If we go back to I think a decent analog, the internet bubble. I mean, the small cap value stocks outperformed the broad index by like 150 percentage points, which is just an enormous amount over a few years. So I think that is a biggie. We are writing a piece on what we would consider what is the safest investment. If you look at something like most people would assume that's bonds or even T-bills. Nominally, that's true, but after inflation, that's certainly maybe not true. And so what do people do with their money? That was a blog post called the Stay Rich Portfolio, but we're trying to expand that into a longer paper at some point with some non-consensus views. I have a running Twitter thread called what does Meb believe that 75% of my professional peers or more do not believe? And that's almost up to 20. And so there was another one I think it's important to be a global investor. We did I think an eye-opening chart that demonstrated what if you didn't invest in US stocks at all? And that's kind of a crazy premise for a lot of people, because most people, it's like the default question is, why should I invest in foreign stocks, right? And then I always like to flip things. And I say, okay, well, what if you didn't invest in US stocks at all? And most people presume that would totally destroy the returns. And the reality is it doesn't really even matter, which I think is a strange takeaway for most people. And so the things that probably do matter is, not paying a ton in stupid tax inefficient fees and ignoring taxes and behaviorally doing dumb things. Lastly, we got a new office. So, we're hopefully going to be in by year end. We had to wait till Mercury got out of retrograde to sign the contract. That wasn't my doing. That was the counterparties, the owners. But we're trying to build out a new office that's close to the water. So if anyone wants to come out and check it out around Christmas time and the new year, fingers crossed, we hopefully should be done.
That's awesome. Where, like, which beach are you close to?
Manhattan Beach, California, right in LA.
Nice. Yeah. What are your thoughts on all these people like leaving California? Do you think the trend's gonna stick, or keep investing in new buildings as everyone else is leaving?
Mid-April every year, I'm always whining and moaning and cursing as I spend like a week doing my taxes. Now that I do enough private investing, it's usually in August. But either way, there's a period every year where I'm questioning my sanity of living in a state with such high taxes. But then I'll go down to the beach or go hiking or do something and watch the sunset and be like, there's a reason so many people live here. It's kind of nice after all. But, I got a lot of people in Colorado and North Carolina and other places that I think would certainly be just as happy. And but for now, this is still headquarters, but who knows, with the world changing, that could change in a heartbeat for sure.
Meb, thank you so much for the time. Really, really appreciate it. And I know we got a lot out of it. People that listen will as well. So thank you for all you do. And thanks for joining us on the show.
Yeah, guys, it was a blast. Thanks.